Cliff Hudson is chairman and CEO of Sonic Corporation. He joins us on set, and he's brought burgers.
Burgers, and by the way, this is a pickle juice slushy. Is that right?
That's correct.
Is it sour?
It's sweet and sour.
Sweet
go ahead and try it. I think you'll be surprised at it.
Well, you know what? It's so thick that you can't
It's stuck in the
get through
straw.
the straw.
Is it good?
That's interesting. It actually is good.
Yeah,
It's
there it
like
goes,
drinking an ice pickle.
Okay.
But sweetened.
A little sweetened, but not really sweetened.
Keep your eye on them, and you'll see here.
Same-store sales. You see what's happening to the stock this morning. The economy's going gangbusters, isn't it? We got tax cuts, et cetera, et cetera. And I'm surprised to see a decline in same-store sales. They were small, but it was a decline. What happened?
Well, for the system, a 20 basis point decline. For our company stores, a 20 basis point increase. The fact is, as the quarter went along, in the month of May, we had 2.5% positive. Earlier in the quarter, the primary thing that was causing some bumpiness was weather, and as we got beyond the weather, then sales were consistently positive. So as we told the market yesterday during our release, May was 2.5% positive. Into June, we've seen no deterioration from that. So now that we've got beyond some of that cold weather, late cold weather in the spring, we've really seen much more consistent positive, and I think we're on a very good track.
And the stock had rallied pretty tremendously.
Well, and this is part of it when you talk about the stock being down after close yesterday. The stock had about a 40% run up in the last month, so there was probably an opportunity for a little profit taking and maybe a little air in.
But should I read anything broader into the economy or to what's happening with your consumers when you see a slight same-store sales decline in some of the stores?
Yeah, well, the fact is ours have been, so the winter was tough, in particular from a weather standpoint, but as we've gotten beyond that pretty consistently, we've moved more positively. No, I would not read anything into the consumer or the economy based on this kind of flat for the quarter, because it was generally up, and as I said, May was a positive 2.5, so we think we're on a pretty good roll now.
I mean, after being flat for almost a year, look at that thing, it skyrocketed, and
I was going to say, what are the themes that matter right now in terms of the industry? You hear about it going through these phases. I mean, it's always promotional.
Right.
It's always about kind of getting more for less. But is it particularly intense right now?
Well, it is intense, and that's a large part because some of our largest competitors have focused on discounting for quite a while now, and they've been stealing share from some of the more super regionals or regional concepts. So our approach has been to focus on that value, and there's some discounting associated with it, but differentiate the product. In other words, as our business got better this spring, one of the things we came out with was we call it a signature slinger burger. And what's the appeal there? Well, one, it's $1.99, but it's also engineered to be $1.99. The beef patty is blended with mushrooms. It's only 350 calories, probably 40% fewer calories than the lowest of its competitor burgers. So 350 calories, has a good earthy taste about it. It's on a brioche bun. It's really a very nice product, and it really helped our sales quite a bit through the spring, particularly with women. So this is how we try to do that. Differentiation, but we don't ignore value.
Did you bring one, she asked disinterestedly?
I will find out if we've got one.
Well, we were talking about, what was the burger someone was selling this morning for $180?
The Wagyu
beef burger.
Yeah, you're going to have to compete with the $180
Ours
burger.
is around 180. The decimal point's at a different place. So.
You're rolling out mobile ordering, right?
We are.
How hard is that?
Well, the difficulty is mostly, I think, behind us, in fact, because the difficulty is about all of the technology we've put in place. The whole platform, the network we've built over the last several years requires a new point-of-sale system at the store, requires a customer interface in the stall, requires the customer to have a smartphone, but that's in place. So now what we're doing is updating the app market by market. It's now it's in stores representing about 29% of our sales, and it makes it easier. Your guest that you had on just a moment ago that was on the screen was talking about convenience being such a major factor. This in the QSR business is going to blow away convenience. And the reason it is the customer can choose where to order, they can choose where they want to pick it up, they can set the time they want to pick it up, all in the app, and then pull into the stall, connect with the stall on their app, and literally be first in line, have their food in 2 minutes that they've totally customized. So I think it's going to change convenience for our industry. And the good thing about it, because we have 25 parking stalls, we're the only one that can do this in the QSR business.
That's what
QSR stands for quick serve restaurants.
You had to do this on a customized basis, though. You couldn't outsource.
That is correct.
Did you outsource this to somebody else?
We tried that, and then we built it ourselves.
Hey there. there. Thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.